Welcome. I'm Frank Holsteen, Managing Director of Investment Management at Wespath. I manage the team that oversees our investment funds, and I'm now joined by Johara Farhadieh, our Deputy Chief Investment Officer. We're going to spend the next few minutes talking about markets, how stocks and bonds finished the year in Q4, and what drove them throughout the year. Johara, thanks for being here with us.
I'm so excited to be joining you, Frank. This is really the first of many market updates that we'll be doing together. I'm looking forward to it.
One theme I'm interested in diving into is the concept of narratives. We've got a few movie buffs on the investment team, and I'm not talking about character arcs and plot holes. I'm talking about how many times we saw the prevailing investment narrative shift throughout 2023. Our asset manager partners at JP Morgan said recently that 2023 certainly didn't follow the script most strategists were projecting. We started the year with investors worried about high inflation and a recession. Then we took an unexpected turn in March during the regional banking crisis. By the end of the year, people were talking about the Magnificent Seven stocks, softer inflation, and possibly even interest rate cuts. What do you think explains all of these shifts in narrative?
Well, first, I have to admit, I'm definitely not a movie buff, so I'm glad we're here to talk markets, Frank. While the end of the calendar year is a natural point of reflection, if you zoom in on any year, it's likely you're going to see investors shifting and changing their mind. As you know, it's notoriously hard to nail economic and market forecasts. The beginning of the year is when a lot of predictions do come out. And so in my years as Chief Investment Officer, I've trained myself to filter through what I call the noise, these narratives shifting. Taking the lens of a long-term investor, I take the information that I think is most relevant for our portfolios and investors, focus my attention there, and ensure our strategies are aligned with such views. In the context of 2023's shifting narratives, let's also think about what the world has been through over the past few years. As we've noted many times, our lives were forever changed by the COVID pandemic. More recently, if anything can shift a narrative, we've had several regional wars escalate, beginning with Russia's invasion of Ukraine, then Israel and Hamas, and now with the tension increasing in Yemen around the Red Sea. We can consider the potential of economic impacts of these conflicts, but I also want to recognize the tragic impacts on lives in the communities. So to get back to your question, it could be that we're all trying to understand the long-term impact of all these changes.
Yeah, good point. So the real economy and what goes into economic forecasting have changed. Let's just quickly touch on Q4 equity markets and where things ended for the year. On this slide, we see a lot of double-digit numbers. The S&P 500 gained nearly 12% in the quarter to end over 26% higher for the year. International stocks finished more than 18% higher for the year. And of course, the stocks of those very large mega cap companies soared, ending the year with almost triple-digit gains. What comes to mind when you look at the chart, Johara?
Well, Frank, I see what you see. I see good news for those investors with equity holdings, especially after 2022, which was a really tough year for stocks. As you mentioned earlier, Frank, declining inflation gave hope for potential Fed rate cuts in 2024. Along with third quarter corporate earnings coming in strong, this gave a boost to equities to end the year. Perhaps a surprisingly stronger boost than many had anticipated. But we also know that historically, equities perform well in the fourth quarter. But of course, there's still a lot of question marks. The December inflation data was higher than expected, highlighting that the Fed has likely more to do around inflation, significantly lowering the chances of the first quarter rate cut. We also don't know how much the economic growth will cool this year, if at all. Mm-hmm. But while we hear a lot about soft landings, I also think as investors we need to consider volatility, shifting narratives, so considering a bumpy perhaps or a more choppy landing at times. As recently noted, we're seeing significant layoffs happening in the beginning of the year. I know Citigroup announced the layoff of 20,000 employees. We know BlackRock, Amazon, Spotify. At the same time, I recently read that JP Morgan is looking to add employees this year, again. And of course, as you point out, there's a focus on the concentration in those mega caps that we've talked about. So there are questions about not only the Magnificent Seven, but also the 490 plus other names in the S&P 500, Frank.
Right, let's talk about that a bit more. We've obviously heard a lot about the Magnificent Seven recently, and our team here at Wespath has been covering it throughout the past year. Our friends at JP Morgan also provided some interesting data on this market concentration. In 2023, the top 10 S&P 500 stocks returned 62%, while the other 490 stocks returned just 8%. And 72% of the S&P 500 stocks underperformed the broader index, which is the second highest percentage since 1980. What do you make of this pretty remarkable trend?
It really is remarkable. As we've talked about recently, there's excitement around tech and artificial intelligence. And perhaps with good reason. AI is really probably going to transform the world. And there will undoubtedly be companies that will profit significantly by leading this transformation. This is probably best evidenced by NVIDIA, which is the strongest performing Magnificent Seven stock with a 239% return last year, Frank. NVIDIA is a computer chip maker that's directly targeting the AI and machine learning industry. Time will tell us exactly which of these companies will profit from the AI transformation, but for now, the Magnificent Seven do demonstrate strong earnings growth. That evokes more confidence and faith in the group of the stocks versus the dot-com era of the past, which was the last time we saw this level of market concentration. Beyond that, there also may be some impact resulting from the popularity of indexing, where investing in market cap weighted indices is inherently tilting people towards these massive companies or mega caps. And finally, maybe we're thinking about this a little wrong. Maybe we shouldn't be focusing solely on the Magnificent Seven, but also considering the 100 of other stocks in the S&P 500. What does the rise of the Magnificent Seven mean for those other companies? Were opportunities created for the rest to rise as well over time?
Well, that's an interesting point, Johara. These Magnificent Seven are great companies with strong earnings potential, but we also need to remember that we've seen this market concentration pendulum swing in the past. So this would tend to reassure more diversified investors with a long-term horizon that there's still an historical benefit to keeping that diversification.
I agree, Frank. Diversification is key in the world that we're in, and the pendulum does swing.
Let's switch gears here a bit and look at fixed income markets. It was a positive year for bonds, which similarly to stocks is a relief after the volatility of 2022. Where should we start with the fixed income landscape?
Well, let's take a look at the yield curve. That's where we always start. On this slide, the orange line is the yield curve at the end of 2023. The blue line is where we started in the quarter, and the green line is where we ended in 2022. One thing stands out to me. The longer end of the curve fell to end the year, leaving us pretty much where we were a year ago. It's basically where the orange and the green line meet, Frank. That's certainly interesting, considering all the narrative shifts and the things we've learned since then. We didn't see a recession. We've had another 100 basis point rate hike. Inflation was about 6% at the end of 2022, and it's now about 4%. So a lot's changed, and yet when you look at the longer-term view on the yield curve, it's very similar. And as we noted earlier, equity markets ended the year strong, along with these fixed income markets.
Right, so let's look at those returns now. Here we see the Bloomberg US aggregate finished the year up 5.5%, while the Bloomberg Global aggregate gained 7.6% last year. Those full year numbers had a lot to do with Q4. Actually, heading into Q4, the US aggregate was on track to post its third consecutive negative year. That would have been an historic first for the index, but as you noted, yield moved lower on the quarter, which helped bond prices surge into the green for 2023.
There really is a story to tell on the bond markets. This is a good time to give kudos to our colleagues. Recognizing that, several members of the Wespath team contributed to a series on fixed income opportunities last quarter. We had Connie discussing the fixed income market as a whole. Peter dove into private credit. Evan looked at the advantages of actively managed funds. Those are all up on our Investment Insights blog, and I encourage viewers to check them out. They're timely reads.
Agreed, those are excellent resources. Any final thoughts as we wrap up?
Well, how about the Bitcoin ETF?
Yes?
Okay, I'm just kidding, Frank.
Okay.
That's something for us to discuss at a later date.
All right.
My final thought is back to the idea of these narratives shifting. We should avoid being reactionary in the short term. And as you know, so many economists were wrong about the recession. Many Wall Street analysts were wrong about the markets being down. And as fiduciaries, we'll continue in our disciplined long-term approach, building diversified funds that allow for our clients to make choices based on their investment needs. So as you know, the main driver of returns in is the client's asset allocation. So filtering out the noise and making long-term strategic decisions should be the focus. And most importantly, the Wespath team, including myself and you as well, Frank, are available to work with our clients to determine the right portfolio for their organization.
Absolutely, Johara, and thanks for joining me.
And thank you, Frank.